David, I know your first concern is for the health of your employees, but the health of the country has to be a close second. Tell me, David, what is your base case scenario for how long the economy is in shutdown?
So, there's been an enormous amount of work that's gone in to try to estimate the GDP impact, both for the U.S. and for the global economy. And I have to tell you, Eric, I think that this is largely an exercise in futility. At the moment, I think we're better off acknowledging that effectively that is an unknowable question, and that we're better off focusing on the things that we do know and what we can take action on. We do know that this is going to be the largest single drop in demand that we've had in modern economic history. And that is going to create an unbelievable squeeze on liquidity for small businesses, for middle-sized companies, for large businesses, and for individuals. We also know that this could turn into a very significant credit crisis. And what we're focused on is how long the economy is likely to stay shut. Because if it stays shut for a short period of time, then we would see this staying largely in a liquidity problem. If it remains shut for 6 to 9 months, that's where you get into the questions of very significant credit impairments, and that is a whole different kind of crisis that we need to be preparing for. But we're working hard on both of those without, at this point, trying to predict what we would say is an unknowable outcome for the basic path of the infection.
As time goes on, David, respecting, of course, the point you just made, that in many respects, or trying to make predictions is, as you called it, an exercise in futility. As more information becomes available, as you get a better sense for how fast the virus is spreading, particularly in this country, are you and your colleagues finding yourselves moving toward that conclusion that this is going to play out for much longer than 3 months? It's not going to be over at the beginning of June. We're looking at September and possibly even later.
So I think that our view very much is that investors at the moment are not taking seriously enough the possibilities that this could be a much longer and more drawn-out affair, and that the popularity of the sharp V-shaped recovery we would say has gotten significantly less likely. At the same time, we would say that investors need to be preparing their portfolios for the very significant opportunities that will present themselves on the other side of this. I mean, if we look at what happened in the GFC, some of the very best vintages of money that we put to work were in 2009 and the beginning of 2010. And it's very important that we get our clients to the point where they have strong foundations, money to put to work, and that we move aggressively into risk assets when we see this thing turning. And it's at that point, I think, that we'll be able to say that active management has really begun to take advantage of these opportunities when viewed through a cycle. And that certainly is what happened to our investment track record through the GFC.
David, the S&P 500 is still trading at 16 times 2020 earnings. On the basis of that and other things you see, have financial markets fully and properly discounted the fact that we're entering what is likely to be the deepest recession in modern history?
So at the moment, we would say that the market is struggling to effectively price in the various scenarios. And partly that's because this point I made earlier about it almost being an unknown how this is going to play out. Markets do very well when
I'm sorry to interrupt, but if it's an unknown, David, what's the most prudent course of action? Optimism or frame of mind? Optimism or pessimism?
So, as I said before, I'd say our view is both. In the short term, we are more pessimistic than the consensus estimates that are there, and we are working hard on defensive positions for our clients. On the other hand, longer term, we remain very optimistic, and we think that there will be significant investment opportunities that will come out the other side of this, and we want to make sure that we've got the cash and the firepower to take advantage of that on the other side.
David, are you seeing evidence in your credit and real estate portfolios specifically that businesses are starting to miss interest and rent payments?
We do. There's been no question that businesses have started to decide that they're not going to pay rent as one of their levers to pull. In real estate, in the equity businesses, I'd say it's too early to say. As you know, those tend to lag by 6 to 9 months, the public markets, and so we'll see that play out over time. But the early signs of stresses in real estate and in private credit certainly can be seen.
And I know PGIM is a significant investor in structured products. I've heard that there's still a serious lack of liquidity in places like the non-agency mortgage market. Are you seeing that? Are you experiencing that? And do you see liquidity stress elsewhere in fixed income and credit?
So as a point of context, I would say that the liquidity stresses have gotten much better over the last 10 days. If we had been talking at the beginning part of last week, literally there were whole parts of the fixed income markets where you could not get a bid on a bond. And we were very worried about the basic functioning of it, let alone the level, but just the functioning of liquidity in the market. I give full credit to the Fed who moved, I think very rapidly as well as with strength. And we now see, for the most part, liquidity has returned to most parts of the bond market. Still not as good as it needs to be, but it's an awful lot better. That said, there are pockets such as the mortgage market you described where there still are real stresses, and we do need more support.
David, a growing number of investors say the Fed's new TALF program is inadequate because it backstops only AAA-rated debt. What do you think? Does the Fed need to loan against a broader range of investment-grade collateral?
So if you buy my argument that we're now in a liquidity event, but that it has the real possibility of moving to a credit event, as we see that this becomes a credit event, the government will absolutely need to provide more support into the credit markets broadly, without a doubt.
But it doesn't need to do that just yet.
I don't think we have enough information yet to make that call. But if this does continue to go on and we start to see, we saw this week a big chunk of downgrades, if those kinds of numbers continue, then we will absolutely need the Fed to expand its program.
And David, what about the banks? I've heard that some banks are being very aggressive with margin calls, and margin calls may not be something that PGIM is seeing, but I'm curious to know, what's your perception of bank behavior right now? Are they being constructive, or are they pouring gasoline on the fire?
To be honest, we have been really pleased with the behavior of the banks. We have obviously been working hard hand in hand with them on our private credit portfolios in real estate, and very unlike the situation that we had in 2008. They have been, I think, both empathetic to the situations with the borrowers. I think they understand they need to get on the same side of the table, and we found them to be flexible and adaptive this time around. And so I have nothing but positive things to say about our experience so far. They're
working hard to term out some of the revolving credit that has been drawn. Was PGIM one of the buyers among the buyers of the debt we've seen issued recently this week, including by Carnival, for example, and Tenet Healthcare?
So we're obviously an enormous player in the public fixed income markets, and when we have a week like last week, or indeed, if you look even at the whole of the month, we have been very important buyers of a whole range of the new issues that have come to market, and that's actually been an important part of beginning to solve some of the liquidity crisis. Is the fact that we have finally really opened in a big way the new issue market.